Get on board, get on track, get to where you're going. And now, your Edutrainer National Insurance columnist, Steve Savant.
Well, welcome everyone. I'm Steve Savant, your Edutrainer and coach for today's entry level into life insurance. And this whole series this week is called The Essentials of Life Insurance. And it's brought to you by Lincoln Benefit Life, an Allstate company. And one of the reasons why we're using Lincoln Benefit Life software is because we selected it as the most user-friendly software, and we think it'll be great for your learning experience when you're dealing with us. Just go out to their site. This is exactly what the homepage looks like when the site I give you, www.lblsales.com/ETW. When you come on the front homepage here, you'll see Run Installer. Just click on it and download the software, and then you'll have it with you. You'll be able to go page by page. Next week, we're going to start getting into it and start using some of it, and you'll definitely want it on your system. So go out to www.lblsales.com/ETW, and you'll be ready to go. Also, we're giving away our life insurance manual with the patented vocabulary. It's really great. I printed out. You can always have it right by your side, your vocabulary and your life manual. And all you have to do to order that is write me at thebiz@brokersalliance.com. That's thebiz, THEBIZ, @brokersalliance.com, and we'll send you the life manual and the vocabulary. And anytime you see additional documents, if you say, boy, I wish I could have that document, just go ahead and write me at thebiz@brokersalliance.com, cite the document I used inside the video, and we'll send it to you. Happy to do so. Well, today we're talking about cash value buildup or cash buildup. And what I like about this is I'm going to use the whiteboard predominantly today because I think the visual is easier than to try to explain it from a technical point of view. Anytime I'm using cash value policies, I'm wondering, am I doing it to maintain the coverage for indemnification, or am I using a cash value accumulation so that I can use it later on for supplemental income? Whatever the reason might be for supplemental income, it could be college, it could be retirement, it could be taking money out for a brand new home for a down payment. Whatever your accumulation needs are, I want to look at it and say, if I'm doing it for accumulation, if I'm doing it for supplemental income, I want to be able to manage the expense loads on this contract so it performs as well as it possibly can. Now, as an example, I'm going to draw a timeline here. And on my timeline, I want to be able to say, during this time of accumulation, I'm going to have an accumulation period. And there's going to be a time when I'm going to have a distribution period. And when I have a contract, I have to be careful because I want to say, what am I going to do with the life insurance? And if I buy life insurance for indemnification, my death benefit is going to be up here higher than it would be if I bought it for income. And one of the reasons is we're trying to see how many premiums can I put inside during the accumulation period. How many premiums can I put in here and buy the least amount of death benefit? The lower the death benefit, the greater the possibility of cash value accumulation. And what I want to do is I want to know, what can I do under the regulations that will allow me to go ahead and buy the least amount of death benefit for the highest cash buildup? That's always my goal on an income scenario. So if I'm looking at this and I go back and say, okay, based on that, I'm going to put in, and I'm just going to do one off the top of my head that I actually know. I have a female, 45, non-smoker preferred. Actually, in the case that I just did, she's super preferred. And she's willing to put in $10,000 every year for 20 years. And another issue is, as I said, I wanted to see what option gave me the least amount of cost of insurance. So I looked at level death benefit, and I looked at increasing death benefit. And I noticed that when I used increasing, it only bought me about $290,000 of death benefit, and the cost of insurance, the COIs, were less than if I would have bought the same under level. So I said, that's what I wanted. So I chose that option option B, or increasing, as my death benefit to get me to my $290,000. Now, when I look at $290,000, that's not a lot for $10,000. I mean, you could buy term for that. But remember, we're not buying it for that reason. We're buying it to see how much accumulated cash we can get inside the contract. And I noticed that when you're doing the death benefit as an example, the death benefit will start out at $290, and it's ever increasing. And it keeps going and keeps going. What I want to do is, I want my cash value to actually grow, and it'll start growing, and you'll notice it'll start closing in on this gap. The DEFRA corridor is what this is called. It defines the difference between an investment and an insurance in our world, so that that corridor always has to be maintained, somewhere around 15%. It's a little less than that, but for our purposes, it'll work. And what I want to do is, at the time of distribution, let's say age 65, I want to be able to look at that age 65 and then drop the death benefit, and that will push my cash values up during distribution. This small little tactic can bring anywhere between 200 and 270 basis points rate of return by managing the cash buildup. Now, when you say, Steve, boy, this looks a little complicated, it really isn't. All computers, including the software we're going to show you with Lincoln Benefit, it's all going to have this on there, and we'll show you exactly how to do the test. It's easy to do, and what I'm doing is I'm going every place along the timeline. I'm saying, can I lower that death benefit again? Can I manage the expense loads down so that my cash values go up? Managing this issue is a huge issue. First, I always have to figure out, do I want to do increasing or do I want to do level? Now, when I think about all the things that we want to do in a cash value buildup, I want to be able to draw my timeline out and say, this is going to be my accumulation period. Let's go green. This is going to be my distribution period. And I want to know when I can take out withdrawals to basis and policy loans of gain. And it matters because during the first 15 years of a contract, as I said in yesterday's class, we have to watch out for this thing called the force-out rule. And one of the good things is that many organizations, we're one of the top organizations that understands this rule and manages it into the ground. If you have clients that are looking for tax-advantaged income, but they don't know, hey, when can I take out withdrawals to basis? When can I take out policy loans? And if I took it out in the wrong year, I'd have a taxable event. That's a big issue. So we want to manage this time period during the accumulation and during the distribution. Once I've chosen which option I'm using, am I using level death benefit or am I using increasing death benefit, then I can begin to manage the timeline. Here's another one we're going to do. We're going to put the grid online. And here's why I'm using this so I can write a little straighter line. Now, here's what I want to do. In my option or my example, I used a female 45 non-smoker preferred, super preferred. And we asked for $10,000, which bought us the lowest possible death benefit, $290K. That's it. If I went $1 below that, I would actually now have a modified endowment contract, which we're going to be talking about tomorrow. And if I did that, I'd lose all the tax-free status. It would be treated just like an annuity. I'd be able to take my basis out free, sure enough, but all my gain would be ordinary taxable event. To prevent this from happening, every computer illustration software, once you turn on check for MEC, check for the MEC, which we're going to talk about tomorrow, you'll want to be able to always put that check mark on, and we'll show you how to do that next week as we get into the illustration system. We'll show you how to do that, and it's really important because once we know this is the minimum death benefit I can go down to, then the next time I want to manage this is at distributions. So my death benefit's growing because it's increasing in my option, which is option B. But then at the distribution period, I'm going to drop the death benefit once again. I have two choices, depending upon the carrier and depending upon the illustration. I'm going to drop the death benefit again down to the DEFRA corridor. That's the corridor we talked about. And then I'm going to also switch my options from increasing back to level. And again, if you have actual cases, let us do the first 5 or 6 for you so that we can really get you comfortable with this. And we'll walk you through exactly on the Mondo board how to do this with your own software. And of course, you should have already downloaded LBL's software so that you can go page by page with us. And I said, about 2 weeks from now, we're going to be into some of this idea. So when I'm looking at managing my expenses, if I can suppress and buy the least amount of death benefit, my cash value will be great. And here's the bottom line. If I make, and I'm just going to use this as a rule of thumb, if I made 10%, during my distributions, I should be only spending 100 basis points. Because I've suppressed my cost, I bought the right policy loans, I'm managing the timeline all along the line, and if I can, my gross is 10 and my expense loads during distribution is 9%, that is a great deal. That's pretty efficient. That was my cost to get tax-free, and most people's tax brackets are greater than 100 basis points. So it's a really good arbitrage. Now, here, when I'm looking at death benefit, I've showed you death benefit. Remember, level. A lot of people call that, in their language of all the carriers, option A. Increasing. Option B. Switching at distribution. Picking the right policy loans, and knowing when to take withdrawals of basis. So if I had to take my money out during distribution and it was still within the first 15 years, I could elect to do policy loans any time during this 15 years. Then after the 15th year, do my withdrawals to recapture my basis, which costs me nothing, it's free. So I definitely want to do this. But then I want to be able to then return for the rest with whatever's left for policy loans so that I can manage tax-free without violating any of the rules. And again, when we walk through this tomorrow, we'll talk a little bit more about MEC rules, why it was developed, and how we are able to actually design our contracts not only to be regulatorily fit, and we're doing the right thing, but to really give the most bang for the buck for the client. And managing like this can bring in a huge, huge rate of return. So the first thing I want to talk about when you're talking about cash buildup is I have to manage expenses. And remember, there is the policy fee, that's an expense. Then I have admin costs. Then I have cost of insurance, which is the biggest thing. And that's the thing I'm trying to manage in my cash buildup scenario. Those are our three big items. Some variable contracts are going to have M&E charges for the fund itself. Some contracts actually do front-end loads and charge by the premium, annual premium. Four of these we can do nothing about. They're static on everybody's policies. But the one thing we can do is right here, cost of insurance. By knowing what level or increasing death benefit and the amount to purchase, we can manage the cost of insurance down so much that we're actually doing the client a major service by trying to contain internal costs. And by the way, this actually kind of halts the argument from people who detract from us for using life insurance for these kind of tactics. Because in my view, as long as you're managing the cost of insurance and really bringing it to the ground, you're going to have the greatest possibility of cash value buildup. That's our end game, because distribution and tax-free is our final goal. When you look at this, cash value buildup management, we're only really managing this. So it's very important to keep in mind, this is one of the essentials and one of the things you got to know when you play supplemental income.
This has been an Edutrainment Workshop, the educational division of the National Insurance Clearinghouse, the marketing arm of Brokers Alliance, and sponsored by Lincoln Benefit Life, an Allstate company.